Peter Lynch, who is one of the most famous and most acclaimed investors of all time, always used to say that small caps are the ways to obtain high returns in the stock market. So what better way to start the day than by looking at a small cap which obtained 50% growth year over year and in 5 years has only returned 45%. As you can see, it peaked in late 2021, start of 2022, and since then it is down over 60%. We're looking today at a company that has great future growth prospects with an attractive product portfolio, and for a small cap, it is generating consistent growing cash flows, which is exactly what we like to see. So this company is none other than Semler Scientific, a healthcare company. So their mission is to develop, manufacture, and market products that assist their customers to treat chronic diseases. They have two main products/services. The first one, which is their patented product, which is called QuantaFlow, measures arterial blood flow in the extremities. I believe they have a patent for this product up until 2027, so they have 4 years to go. And they also have an FDA cleared software product that recommends optimal insulin dosing for diabetic outpatients. Additionally, they have cash investments in two companies, which is one offering a proprietary product which has technology-enabled approach to inpatient glycemic management, which is to allow patients who have also diabetes to help them manage the disease, and another one who is providing a product that is an early test to detect Alzheimer's. They are currently working on improving and updating their QuantaFlow product, and additionally they are researching and attempting to develop new products in the area of expertise. So their financial analysis looks beautiful. They have an impressive return on capital employed of 27%, which means that for every euro that they obtain from either equity or liabilities, they are able to make 27 cents out of it. That is insane, and for the pharmaceutical industry, it is in the top percentile of the industry. They have an interest cover of over 100. I put 100, but the truth is that they have little to no interest, so they are sound, safe and sound in that aspect. They have a cash conversion of 101%, which means that their total income that they bring is converted into free cash flow, which in the end of the day is what we get as investors. And their profit margin is a stunning 92% with an operating margin of 30%. There is a big gap in between the profit and the operating margin, but in the latest call, they actually said that they are focusing on reducing that by reducing headcount and other SG&A expenses, which is exactly what we like to see from a company. So their fundamental analysis, we give them a 6 out of 8. They have low liability risk, or basically no liability risk. They have an extremely solid balance sheet, and they are very cash flow consistent for a small cap company. The two things that we were missing were that they don't conduct share buybacks and they don't pay out a dividend. But we believe that since they have such a high return on capital employed, these are not necessary, as we want them to invest in their business as much as they can to obtain that juicy 27% return on capital employed. Additionally, I believe they don't have pricing power because although they have a patent, it is heavily regulated and they are stimulated a couple of rules that they must follow, and I believe pricing falls under those categories. But regardless, they have an organic free cash flow growth, organic revenue growth, and they have an existing moat/competitive advantage since they have a patent on the QuantaFlow product, and they have a huge area of expertise in that area, which they will be able to leverage to develop new products, I hope. For the long-term analysis, I believe that they are following secular trends, as their product that they offer are very digitalized. They use products that not only tell you about the information of the patient and how they are performing, but it also gives you a lot of insights. Well, not you, the doctors, give them a lot of insights, and what they have been able to do is reduce the barriers of entry for doctors to conduct the type of tests that must be conducted for arterial diseases and other checkups that must be done. And I believe they have two main growth avenues. The first one being the improvement of the current offerings of QuantaFlow and the other diabetes project. And they also have a second avenue, which is through new product development. They don't like to disclose information on this. I believe it's to prevent competitors from stealing or differing with their research. but they say that they are consistently investing around 2 million, I believe it was, which is a lot for this company. It's a very small company, on development, and they believe that this will improve the company's projections going forward. In terms of valuation, it is trading at just under 20 PE ratio. It's trading at an 18 PE ratio, which is not bad for this company. I believe historically it is cheap, although from 2020 to 2022, it was trading at a higher PE due to higher expected growth rates. And now they are trading back up again after having a mildly disappointing 2023. They are now at 18 PE ratio. I believe this is a good valuation. I would like to see the price come down before I make an investment, however. Their free cash flow yield is at 4.67%, which is a lot higher than the long-term inflation rate. And we use this as a rule of thumb that Terry Smith created himself, which is that if the free cash flow yield of a company is higher than the long-term inflation rate, it is an attractive price as the company will grow in the following years. In terms of risks and possible challenges, I've put competitors at 50% because although they do have a patent, I believe that a small company holding a patent for 4 years is at a high risk of other competitors developing similar products if they wanted to, or interfering with any research and development they are currently carrying out. In terms of regulation, I put a 70%. I would be between 70 and 80% since their products are heavily regulated, especially the one with the patent. In terms of performance and market, I put both at 40% because there is a chance that they may happen. However, I don't see any big risks right now going this company's way, and I like to be a bit conservative in my investment thesis and investment analysis. Just if anything goes wrong, we kind of predicted that beforehand. So before we move on, I do have to say that this is not financial advice. I'm not a financial advisor, so anything I say, please don't take it to heart. Do your own due diligence and research on the stock before buying it. But for the investment conclusion, for the sake of this video, I believe they have a strong competitive advantage in the area of expertise they are currently in, which would classify itself as a moat. They provide consistent cash flows that are sort of predictable and very resilient for a small cap stock, and they have an extremely high return on capital employed, which is essential in order to create value for the investor. So the outcome is that it is a great company, which will probably return high returns if bought at a reasonable price. So as always, this has been the Cash Flow Compounder. Thank you for watching. Join the free Patreon for extra content and join the link in bio for a free stock when joining Trade Republic.